Hello again, everyone, and welcome to Module 3 of Managing Facilities and Events in Sports, Entertainment, and Media Business. As always, I'm your professor, Robert Romano, and in Module 3, we're going to be talking about financing and budget. Partly, we'll have another video. We're going to start with a premise involving capital projects. All right, so you're going to be engaging in a capital project. When I say capital project, I mean a long term investment project that will increase the assets of your organization. All right, so this is a long term thinking, long term investment, and with the goal of increasing the overall assets of your whole organization. All right, but capital projects aren't cheap. Think about it. The Barclays Center, they're out in Brooklyn, $1 billion investment. MSG, they renovated Madison Square Garden. They spent about 975 million. Marlins Ballpark, smaller venue, 515 million, a little bit cheaper too because there's no unions down there. Olson Field, down in Texas A&M, 20.6 million. So these are long-term investments, a lot of capital, with the goal to increase the overall value of your franchise. All right. Large upfront cash outlays are for land acquisition. You're going to have to pay a lot of money to get the land, the construction, and the infrastructure development. All right. So there's large amounts of money being spent. A large upfront capital being spent on buying the land to build the facility, the construction phases, and any infrastructure, on ramps, exits, routing the cars in and out. All that infrastructure development isn't cheap. Okay. All right. So capital projects. In order to start your capital project, you need to determine whether the project will increase the value of your organization. All right. So should you build this stadium? Should you build this arena? I don't know. Will increase the value of your organization? Then yes. So you need to estimate the present value of expected revenues against the present value of expenses. All right, present value of revenue needs to be greater than the present value of your expenses to build this facility. There are different ways you can finance your facility. First way is through equity finance. All right, equity finance basically meaning you're the owners, you're going to come up with ways to raise money and pay for the facility. All right, so you may have different ways of doing that. Number one, you may want to sell stock. All right, you may want to sell stock. Stockholders will become part of your ownership, however. So in sports franchises, that's typically not done. Um, you don't really want to sell shares of the New England Patriots. All right, Bob Kraft's not going to want to do that. All right. So it's a way to raise money, but is it the way you raise money in sport? Typically, no. All right, because again, stockholders become part of the organization, and when they do that, they're going to want voting rights. They're going to want dividends. All right. Sport teams have limited, or teams are limited in their ability to issue stocks also. So a lot of the leagues put a limit on whether franchises can do this. All right. Exception: Green Bay Packers, of course, because it's where their ownership is. They're made up of the people of Green Bay. They don't have a single owner. They issued stock on two different occasions. One time in 1997, where they raised $25 million for renovation, and then again in 2011, where they raised roughly $67 million in stocks. Issuing stock for people to buy and become owners of the Green Bay Packers. Other teams have done it: the Cleveland Indians, Boston Celtics, and the Florida Panthers. It hasn't worked out all that well for them. They gave up part of their ownership for it, and again, the leagues frown upon it. They don't like it. They don't want the owner. They want a centralized ownership, not 72 owners of a franchise. The owner can also use the retained earnings, their money, all right, their revenue that they generated from their sports organization. They can take this money and build a stadium if they choose. All right, they are basically reinvesting to finance improvements or additions. Right, it's their money. They want to build or renovate their facility. They can do what they want. Do most owners choose this option? No, they're not going to spend their money. They're going to spend somebody else's money. All right, you can also, mostly at the college and university level, you're going to do capital gifts, capital donations. All right. Most colleges and universities are nonprofit, so people can donate gifts to the nonprofit organization, and in return, the nonprofit organizations receive a tax deduction. All right, typically equal to their donation. All right, so this is usually capital campaigns for universities if they want to build a facility. Doesn't necessarily have to be a sports facility, just a facility in general. All right, so they solicit donations. People give donations. These are gifts, considered gifts, and in return, the gift giver gets to write that amount off their taxes. Okay. This is usually typical through capital campaigns at colleges and universities. The second way to pay for your facility, if you don't want to use equity, is through debt financing. All right, this increases your liabilities. All right, you can do this through loans. Problem with loans is that if you borrow $1,000,000, you're not just paying $1,000,000 back. You have to pay the interest on it. All right, and that loan's going to come due. You have to pay it. So if the loan is due every month, every 3 months, every year, every 5 years, whatever it is, you take out that money. You got to pay the principal back plus the interest back on it, and you have to pay it by a certain date. And there also may be some prepayment penalties. So if you want to pay it back early, you may be penalized by the organization that loans you the money. All right, so loans are typically a good idea except for the interest rates. And if we don't know what interest rate is, it's a percentage of the principal charged as interest. Okay, your interest rate is typically going to be based. What your interest rate is going to be is typically based on risk. The more risky the venture, the more risky the people who are engaging in the venture, the higher the interest rate will be. Riskier equals higher rates. It's typical. Maturity is the date that the loan is paid in full. All right. There may be payments along the way that mature, so you may have to pay every month, every 2 months, and every 3 months. And again, you have to pay back both the principal and the interest. Again, and like I said, prepayment positions, there may be a penalty. If there is a penalty, if you pay that note back early, typically it's a percentage of the overall loan. So if you pay it off earlier than the date of maturity, you may have to pay a penalty. Doesn't that seem right? You're giving the money back quicker, but they're going to penalize you for paying it back quicker. Hey, banks are in charge, I guess, right? The NFL also has what they call the G4 program. All right, this is where the NFL will loan teams a certain amount of money, so a team can go and ask for up to $200 million for stadium projects. All right, so they can get a loan from the NFL itself. They don't have to go to a bank. They don't have to go to an outside corporation. They could just ask the NFL, let the owners vote. The owners vote. You can get up to $2 million for stadium projects. It's got nice benefit. It's less risky. There's less interest. The other owners aren't going to charge you a high interest rate. The NBA has a similar program. They got a $2.3 billion league-wide credit. Each team can borrow up to $125 million. And interesting thing about the NBA, it doesn't have to be used for stadiums. It's not specified how a team can use this money if they borrow it. You just got to pay it back. In the NFL, it's for stadiums. In the NBA, you can borrow up to $125 million, and you can use it for whatever you want as long as you pay it back. MLB, similar program. They have $155 billion league-wide. And again, not specified how to use it like the NFL does. So there's $150 billion. You can make other teams can tap into that money as long as the other owners vote that it's okay and do whatever they want with it. Second debt finance, besides loans, are bonds. All right? This is another form of debt financing. Bonds come from a wide range of investors and not just from financial institutions. All right. Again, similar. It's a promise to pay back the principal plus interest on a maturity date. Different than a loan. Bonds are a little bit different, but you promise to pay them back. You promise to pay them back both the principal and the interest. A large number of stadiums use municipal bonds. These are a special type of bond. These are bonds issued by a state or local government. All right, and they're typically issued for the purposes of financing capital projects. All right, so it seems like, oh yeah, well, stadium's a capital project. This may be a good place for me to look for money. So maybe I'll ask the municipality to issue a bond. The best thing from the investor point of view is that if I invest in bonds, if I'm an investor in a municipal bond, it's tax exempt. So when I get my money back, I get my principal, my interest back. That interest money, I don't have to pay taxes on. Okay. Municipal bonds are interesting because they're tax exemptness. The bondholder, again, does not have to pay the federal income tax on the interest received. So therefore, municipal bonds usually have a lower interest rate. All right, so if you want to go get a bond, or you had a bond issued for your capital project, you may have to pay. You're going to have to pay it back, but that interest rate may be lower. Okay, municipal bonds and their tax exemptness. The reason for this, the reason the municipalities issue bonds, is typically for the benefit of the public. All right, so it has to be some public benefit from issuing municipal bonds. Because there's a public benefit, federal governments offer an implicit subsidy by not gaining tax money from it. Right now, it's tax exempt, so they don't make any tax money out of it. So the federal government offers this implicit subsidy on municipal bonds, and it's because the bonds are supposed to be issued for the public good, for libraries, for parks, for hospitals, for schools, that kind of stuff, right? For the public good, and if they're for the public good, the federal government says, okay, no taxes on that for the investors, and this is again like an implicit subsidy. Interestingly enough, like I said, they're issued for the public good, but interestingly enough, professional leagues have used municipal bonds for their purposes. All right, so the local franchise would go to the city and say, why don't you help us out? Why don't you issue a municipal bond so we can build a stadium? The question is, are professional sports stadiums for the public good? My position would be no. They're for the owners' benefit. They're not for the public benefit. Of course, the public gets to go there, but it's not like going to a library where it's for free, or for a park, or for a recreational facility, where the public doesn't pay or pays a nominal amount to enjoy the park, to enjoy the library, that kind of thing. This is the way, professional or sports stadiums for the public good. There's an argument that there's yes, because people can root for their team, all that good stuff. But I don't see it. You make your own opinion on it, but I just don't see it. Interestingly enough, though, since 1986, $17 million in municipal bonds have been issued for professional sports facilities. $17 billion. And since they're tax exempt, it has cost the taxpayers $4 billion in tax money. So the professional leagues, the professional team owners, are gaining another benefit at taxpayer expense. They're asking their municipalities to issue municipal bonds to build a sports facility, knowing that they're not for the public good, arguably. And in reality, because they're tax exempt, there's no taxes paid on it, so the U.S. taxpayers and the government has missed out on over $4 billion on interest money, on tax money. Okay? And this has gone for the benefit of the owners. Okay? All right, with that argument being put aside, another way debt finance way, you have your loans, bonds. Third way is through operational revenue. Okay? This is revenue generated by operations used to finance a facility or to cover its debt. All right, so this is basically securitization. When sports organizations use contractually obligated income as collateral for debt. All right, so a sports team or franchise can use contractually obligated income as collateral for debt. Now, what comes to mind? What would be contractually obligated income that could be used as collateral in sport? You think about it in sports. Well, media contracts. All right, the NFL has $4.5 billion out there in media contracts. You could use that as collateral. Naming rights. Right, Citi Field, $20 million a year for 20 years. You can use that as collateral. Right, sponsorship agreements, multi-year premium seating contracts, PSLs, stuff like that. All that can be used as collateral.